You checked your stock portfolio this morning, and everything's red. Your Twitter feed is full of people freaking out about Japan. Everyone keeps mentioning something called the yen carry trade, like you're supposed to know what that means. Ever wonder why a currency on the other side of the world could crash your investment? Today, I'll explain the yen carry trade like you're 5 years old. By the end, you'll understand why smart investors just borrowed a bunch of Japanese money, why they're panicking now, and whether you should actually be worried. Here's the setup. Japan has had basically zero interest rates for decades. We're talking like 0.1%. Meanwhile, the United States had rates around 5% recently. That's a huge difference. So imagine this. You walk into a Japanese bank, and they'll loan you money for basically free. Now imagine you take that borrowed money and invest it in something that pays you 5% returns. You're borrowing at 0 and earning at 5%. That's free money. That's the yen carry trade in a nutshell. And for years, this wasn't just a few people doing it. This was hedge funds, investment banks, and massive financial institutions borrowing billions of yen to invest in higher return stuff around the world. It was the easiest bet in finance for years. But here's the thing nobody talks about until it's too late. When you borrow in yen, you have to pay it back in yen. Let's say you borrow 100 yen when $1 equals 100 yen. You convert that to $1 and invest it in American stocks. But what happens if the yen gets stronger against the dollar? What if now $1 only equals 80 yen instead of 100? When you sell your investment and convert back, you need 100 yen to repay the loan. But your dollar only buys you 80 yen now. You're short 20 yen. You just lost money even if your investment stayed flat. The currency moved against you and wiped out your gains. And that's the risk everyone ignored because for years, the yen just kept getting weaker, until suddenly, it didn't work anymore. So what happened recently that changed everything? The yen crashed to 155 against the dollar. That's historically weak. You'd think that's great for the carry trade, right? Wrong. Because when the yen gets too weak, the Japanese government freaks out. A weak yen makes imports crazy expensive. Japanese people are paying more for food, gas, and everything else. So the government steps in. They intervene in currency markets. They say things that hint interest rates might actually go up for once. And suddenly, all those investors who borrowed yen start sweating. Here's where things get really interesting. Japan's central bank announced they might raise rates for the first time in decades. That changes everything. If Japan raises rates, the free money tap turns off. Borrowing yen suddenly costs real money. And if the yen suddenly strengthens because of those rate hikes, investors lose money on both ends. They're paying more interest and losing money when they convert currencies back. When investors get scared, they unwind the trade. That's the fancy term for panic and reverse everything. They sell their investments, stocks, bonds, real estate, whatever they bought with borrowed yen. They take that money, convert it back to yen, and repay their loans before things get worse. But here's where it gets ugly. When thousands of investors do this at the same time, it creates a tsunami of selling. Stock markets drop because everyone's dumping assets simultaneously. And as stocks fall, more investors panic and sell, which makes stocks fall more. It's a doom spiral, a feedback loop. This isn't theory. This actually happened in 2008 during the financial crisis. The carry trade unwound and markets crashed. It happened again in August 2024. The yen strengthened suddenly, the carry trade unwound, and global markets had their worst day in years. The Dow dropped 1,000 points in a single session. The Nasdaq fell even harder, and all because of a currency trade most people had never heard of. Here's what makes this so dangerous. The yen carry trade isn't small. Estimates put it at hundreds of billions, maybe over $1 trillion in positions. That's enough money to move entire markets when it shifts. And it's all connected. Japanese investors borrowed yen to buy US tech stocks. American hedge funds borrowed yen to invest in European real estate. Everyone's tangled up in the same trade, using leverage, meaning they borrowed even more money on top of the borrowed yen to make the bet even bigger. It's like a giant game of Jenga where every piece is connected, and someone just pulled a block from the bottom. Now let's talk about why you should care. If you own stocks, any stocks, you're exposed to this. When the carry trade unwinds, it doesn't discriminate. It's not just Japanese stocks that fall, it's everything. US tech stocks, European banks, emerging markets, even crypto gets hit. Because investors need to raise cash fast and they sell whatever they can. Your retirement account probably has exposure. Your index fund definitely has exposure. You don't need to be a Wall Street genius trading currencies to get caught in this. You just need to own assets. But wait, Does this mean markets are definitely going to crash? No. The yen hitting 155 is a warning sign, not a death sentence. It means the carry trade is under stress. But whether this turns into a full unwind depends on what happens next. If the yen stabilizes around these levels, the panic fades. Investors keep their positions, markets calm down. But if Japan actually raises interest rates significantly, that's when things could get messy fast. Or if the yen suddenly strengthens past 140. Think of it like a crack in your phone screen. It's a problem. It might get worse. But it doesn't mean your phone's about to explode. Here's another angle that makes this fascinating. The Bank of Japan is in an impossible position. If they keep rates at zero, the yen keeps falling and inflation gets worse. Japanese citizens can't afford basic goods. But if they raise rates, they trigger a global market sell-off because the carry trade unwinds. They're choosing between hurting their own people and potentially crashing world markets. And right now, the whole world is watching to see what they'll do. Here's the part that makes people angry. Most regular investors had no idea this trade even existed until markets started dropping. You didn't get a memo. Nobody asked your permission. But a bunch of hedge funds and banks made a massive, leveraged bet on borrowed money. And now if it goes wrong, your retirement account takes the hit. You followed the rules. You invested for the long term. You diversified. But because someone else did, you're along for the ride anyway. Fair? Absolutely not. Reality? Unfortunately, yes. So what do you actually do with this information? First, understand that volatility is probably coming. If you see headlines about the yen or the carry trade and markets start dropping, at least now you know why. It's not random. It's a specific thing unwinding. Second, don't panic sell unless you need the money right now. Carry trade unwinds are sharp, but usually short. August 2024's crash recovered most of its losses within 3 weeks. If you're investing for 10 or 20 years, a temporary drop is just noise. Third, if you've been waiting to buy, a carry trade unwind might actually give you a chance. You can grab stocks on sale. Everyone else is panicking and selling. That's when smart money buys. The bigger picture here is that global markets are connected in ways most people never see. A decision by Japan's central bank can crash stocks in New York. A currency move in Tokyo can wipe out gains in London. Your financial future is tied to things happening on the other side of the planet while you're asleep. You can't control that, but you can understand. And understanding it means you won't be blindsided when your portfolio drops 5% in a day and all the headlines are talking about Japanese yen. To recap, the yen carry trade is when investors borrow cheap yen and invest in higher return assets elsewhere. It's been one of the biggest bets in global finance for years. When the trade unwinds, investors sell everything to pay back their yen loans, creating massive selling pressure across all markets. The yen hitting 155 is a warning sign that the trade is under stress. And if Japan raises rates or the yen strengthens quickly, we could see a sharp unwind. This affects your stocks even if you've never touched foreign currency, because global markets are all connected. And the best move? Stay calm, understand what's happening, and remember that carry trade unwinds are usually sharp but short. So here's my question for you. Should banks and hedge funds be allowed to make trillion-dollar bets that can crash everyone's retirement accounts? Or is it time for rules that protect regular people from getting caught in someone else's risky game?